Have you heard of the theater on fire theory? I think Michael Berry, he is one of the guys from like The Big Short.
Yeah.
I think he's talked about this. So if he hasn't, like, disregard. But the idea of the gist of it is if you're watching a movie, everything's fine when everyone's watching and enjoying the movie.
Yeah.
It's like, but if the theater catches on fire, it's like everyone runs to the exit.
Yeah.
And only so many people can get out, and so now you are willing to pay any price to get out of the theater because you now realize it's on fire, right? It's like, so when everything's fine, you can get up and leave and go get popcorn and somebody else come take your seat and whatever, right? It's like you can come and go. But once it's on fire, everyone wants to get out.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of Ducharme Wealth Management Podcast, trying to give everyone the education and insight they need to have better, more meaningful engagements with the financial professionals around them. Today is a really nuanced episode talking about the differences between ETFs and mutual funds and the common misconceptions people have in trying to understand what they have. I'm joined actually by a friend of mine, Aaron Best. He's a certified financial planner, has his own investment firm here in St. George, and has been in the industry for a while. He is very interesting that he is focused entirely on planning and not as much on investments like myself. And so he sees things through a different lens. So I brought him in today to just get an alternate perspective and additional insight, and make sure that I'm not totally locked into my own research here. So with that, I hope you appreciate mine and Aaron's insights about ETFs, mutual funds, the potential hidden costs thereof, and what the use case for each of them might be. Enjoy the show.
Thank you for the water.
You're welcome.
Okay, I'm ready whenever you are.
Okay. So today we're talking about ETFs, mutual funds, stocks, and bonds. I think we'll probably largely just, avoid commodities today. But the big thing that I want to talk about is the common misuse or misunderstanding that people have when owning assets, because they have a guy that does it for them, right? Mm-hmm. And they don't really understand. They're a little bit confused about what they own,
right?
And I think as investors, one of the prudent things you can do is just like, you don't have to understand every micro decision about why you have something in your portfolio or why it's set up a certain way. But I think like generally understanding what you own and why you sort of own it, like what's the general thesis behind it.
Yeah.
Is a really prudent thing that everyone can do.
Yeah. If
nothing else, by like a quick conversation with their advisor, if they hired a good one that even understands why they have in a portfolio, what's in the portfolio. But there's so much misconception out there. So I always hear these goofy phrases people say like, oh, I have a mutual funds account over there. Or I have one of those like IRA mutual fund 401ks. You're like, I don't even know what that means. Or, like just different things. ETFs are like stocks, but they have, but they're expensive. You have to pay a fee. It's like owning stocks, but you have to pay a fee. Yeah. Or people say, well, mutual funds are actively managed. ETFs are passive.
Right.
All right. Just another myth out there. So these are the things that I want to talk about today, and just kind of what's the word I'm looking for? I don't know. This is like a Mythbusters episode. How about that?
Sure.
Yeah.
Sure. It's educational, right? Yeah. It's just education on what these different options are and how they work and what might make more sense, Sure. Yeah. It's just educational.
So, this episode might be a little bit more technical in nature, I think, but it's important to understand. And it's become very apparent to me. I think I had like one of the more compelling experiences I've had since being an advisor this last couple weeks with a client that is, she is helping her husband, who has primarily done the finances, and he's now, losing capacity.
Gotcha.
And she's, utilizing their estate planning documents to step in and help take over on some of this stuff. And they had an advisor for years and years at one of the big box firms.
We love that.
Well, to their credit, the advisor actually did a really nice job for them working with the husband for many years. And then he retired and they got passed off to kind of a younger, newer person that's totally new.
Yeah.
And, and that kind of all happened as he was starting to, kind of downshift gears a little bit. And all of a sudden, he was somebody that really liked to talk to his advisor and, pick stocks and, have a really unique system. And, I don't want to get into the weeds of was that a good idea or not. But one of the things that he didn't really like was mutual funds, particularly because of his belief around the fees and expenses. And when I analyzed their portfolios, they had mutual funds in one account was a brokerage account. So it had what's called A-share mutual funds. And so they had paid a sales commission to get those funds.
Okay.
And then they carried an expense ratio that was, the average expense ratio was over 1% a year, right?
Yeah,
so they were paying
expensive.
more than they were paying more in mutual fund expenses than they would pay to the average advisor. The mutual funds actually were, one was an index fund, which if they bought the same exact thing in like an ETF would be about a fifth of the cost.
Yeah.
For the exact same thing. The other three funds wildly underperform. They're really kind of, I would just say laughable almost in terms of who bought these, kind of thing. Right. And then in one of the other accounts, in a larger account, they had a fund that had what's a 2% sales charge. So when they sell that fund, they're going to have to pay 2% sales charge, which is not a common,
charge.
Not a common thing, but that was an in an advisory account, which is uncommon.
Yeah.
And then they also had a huge allocation in this account that they had no idea was there. And that was to a mutual fund with a performance fee set up on it actually. So the expense ratio on that is nearly 5% a year.
Oh my gosh.
Which is
I don't think I've ever come across one of those.
Not a lot of them out there, but they do exist.
Right,
and anyway, so when I started talking to them, they wanted me to pick stock. They thought I would just pick stocks, like an investment advisor just picks stocks, and they pick the right stocks. Well, that's a very challenging thing to do.
Yeah.
And so I tend to tell people it's easier to be in the right spot in the market than to be in the right stock in the market,
I like that phrase.
And so you can do that with a index ETF, an index fund, ETF or mutual fund, and really quite inexpensive. Now, what I'll say to that is there's no free lunches in finance. And if you're listening to this episode, I will say that again, there's no free lunches in finance. So there's a couple different kinds of fees when you start talking about funds that I like to tell people about. Yeah. So you have implicit fees, you have explicit fees, and you have the fees that are more transparent, like they come right out of the account, right? So you have advisor fee, something that comes right out of the account. Yeah. You see that on your statement. Then you have expense ratios, and that's an explicit fee. It's there.
It's there, but you don't.
If you look, if you look deep enough, it's there. And there's implicit fees. Okay, so implicit fee is payment for order flow, right? Like when you buy and sell an ETF, you'll never see the transaction fee, but somebody out there, when they made market on transacting that, made money between the bid and the ask spread.
Right.
So did you really pay that? No. But was it a cost you kind of incurred? Yeah. What about when you have a high yield savings account? There's a huge implicit fee there oftentimes, right? So if you were somewhere the last couple of years that was paying you, 4.5% on a high yield savings, and the cash rate's 5.5%, guys, guess what? You're paying a 1% fee because you're getting 1% below the cash rate. Now it's not a fee per se, but it's an opportunity cost, right?
Yeah.
So there's no free lunches. So even if you're this account has no fees, well,
someone's getting paid somewhere.
Someone is always getting paid somewhere in finance, right?
Yeah.
And and so yes, is on an S&P 500 index fund or something, will you pay some basis points to have that fee? And would that be more expensive than maybe owning every single share in the S&P 500? Sure.
Yeah.
And as soon as you have $1 billion in your brokerage account, you can just have a properly weighted S&P 500, index fund of your own, right?
Right.
So,
talking about mutual funds, I mean, kind of when I first, I mean, we're kind of young in the industry. It was interesting kind of going back. I mean, financial advisors, that was kind of the tool, the investment vehicle that they had to use was kind of a mutual fund that had these fee structures that we don't necessarily see as much anymore. Now, you have an old account like you had, and you come across it, whether that's these different types of share classes where it's like an A share where there's like fees up front. I have seen them where there's like a fee on the back end. There's these like 12B1 fees where there's like a trail of a fee that's being charged to the financial advisor. You don't necessarily...
that wouldn't be a financial advisor. Like, point of clarification. Well, a 12B1 fee would be...
Is it broker cost?
Well, it gets paid to the broker dealer of record. So an advisor, like a really quick... I mean, this is a nuanced difference, but it's super important. A financial advisor is somebody that is going to be registered with a registered investment advisor, an RIA, like Aaron himself here, or myself, or like Aaron has his own RIA. I'm an investment advisor representative of an RIA, and so we're advisors. We do not get to collect 12B1 fees, even if a mutual fund offers to pay them. We don't collect them, right? It's we get paid by our clients. That is the only way we get paid on securities product like that. Yeah. And if you work with somebody that is not an advisor, they may present themselves to you an advisor or call themselves an advisor, which they shouldn't under the new marketing rules. They are a registered representative of a broker dealer. And that is oftentimes somebody, like, most commonly, I'm going to say they work with firms that end up having the word mutual somewhere in there. Maybe they deal a lot with life insurance. Like if somebody's really big on life insurance, especially like whole life insurance, chances are that they might be a registered representative. You can just ask your financial professional, are you an investment advisor registered with the SEC, or are you a registered representative of a broker dealer? Yeah. This is a point blank question.
No, I appreciate you clarifying. It's like, because that was kind of the old way that things were done. Now we've kind of grown, and there's been a lot more new things that have always been more beneficial to the client. Yeah. And so it's a good thing. It's a good thing that we are moving in the right direction to really help the client kind of save on some costs in a roundabout way, or just better investment vehicles for the client.
Yeah. Well, I got some common myths here about ETFs. So, really quick, broadly speaking, ETFs and mutual funds are described traditionally as a basket of stocks, right?
Yeah, a pool of investments.
And that's a more appropriate way, because it could be a pool of commodities, it could be a pool of bonds. But the idea is you have a little bit of everything instead of, all of one thing, right? Yeah. So, so point of clarification, when you have like an index fund that tracks like the S&P 500 index, it's got exposure to the 500 companies, right? There's a little bit of all the 500 companies. So if you have S&P 600, S&P 400, and S&P 500, you have like 1,500 stocks in your portfolio, right?
Yeah.
And you can have the same sort of idea in ETF or mutual fund, right? So let's talk about some of the myths of ETFs, Aaron.
Yeah, let's do it.
All ETFs are based on passive strategies. True or false?
Oh man, I'm going to say that's a myth.
That's an absolute myth.
Yeah.
So there's been the rise of ETF index funds, right?
Very popular.
Which oftentimes are, if you understand the way an index is created and what an index is, it's actually an active strategy. Like the S&P 500 is an active strategy. The investment team at Standards & Poor's does the investment selection, determine which 500 companies will be in there. And then they rebalance, and they have some rules about how they determine the market cap, but it's by all means, like, it is an active strategy. Now, it's so big and so widely followed that there's companies that will pay Standards & Poor's to license the use of the index, and then they put it in a ETF wrapper. And then that's how you get something like the Vanguard S&P 500 index fund, or the State Street, or the iShares,
Fidelity,
or
Schwab,
the Fidelity,
all
Schwab.
the different.
And it's so broadly used, and there's not a lot of management necessarily required. And so it's just become lower cost.
Yeah.
Right.
Would you say it's because of the lower, the lower work, the less work that someone kind of has to do to put it together, because they're kind of tracking the 500 biggest companies. So there is less work. And so that cost savings goes to the client potentially, or no?
Yeah, I think it's participating in economies of scale, maybe, is like the better way to say it, right? It's just like, this has been the widely adopted benchmark. And so the whole Boglehead theory, right, is if you can't beat them, join them.
Yeah.
So if you can't beat the benchmark, then just join the benchmark.
Yeah.
I think I think it's going to be not surprising to a lot of people that, why don't more people just buy the S&P 500 then in their whole portfolio, and to a select few of people that are younger and just think they know the world, they're going to think, well, that's what everyone should do. It's like, but beating the benchmark is more than just the return, right? So does the risk of that benchmark align with your own, personal financial needs
situation?
And, anyways, but that's, so ETFs don't have to just track a passive index, right? They can be an active equities manager or bond manager, and be utilizing a very active strategy under the hood of that ETF.
Yeah. Okay.
And for what it's worth, when we get to the mutual fund section, I'll just cross that one off the list. Mutual funds don't have to be active either. Sometimes mutual funds can be index funds as well, low cost index funds. Now, the expenses typically are more expensive still on the mutual fund chassis,
which is interesting, but that's just how it goes.
And it's because of the administrative cost.
Additional administrative costs.
Yeah, it's the administrative cost of running a mutual fund versus an ETF.
Yeah.
And the ETF has just, as a industry, has experienced fee compression as a way of popularizing the chassis. So,
okay.
ETFs only track traditional market weighted indexes. I think we covered that one.
Yeah.
ETFs are the same as individual stocks.
No.
ETFs,
they can trade similar to a stock, meaning you've got you can sell it. There's an open market for it. I guess usually broadly. At the same time, usually ETFs, at least in my world, usually have more diversification, meaning you just you have like kind of that basket approach of stocks that trade on the open marketplace.
So the biggest difference between mutual funds and stocks in this regard is that if you have a share of Apple stock, right, and you want to sell it, you can go to the exchange, and the exchange will sell it to somebody else that's looking to buy, right? So you're looking to sell, I'm looking to buy. We both go to the exchange kind of processes that transaction. Yeah. And all of a sudden I own your shares of Apple stock, like the share, right? Like if they were serialized on a blockchain or something, like you could see how it was like your exact shares are now my exact shares, if you will. And so ETFs trade like that, right? Like, so if you have a share of an ETF, it can trade on the exchange to a new participant. Now, it can also go through a create and redemption process with a qualified participant, which is a nuanced point that I would talk more in depth when it comes to the tax side of how ETFs are taxed versus mutual funds. But with a mutual fund, you go through a redemption process. So if you have 5 shares of a mutual fund and I want 5 shares of the same mutual fund, we don't go to an exchange and you sell me your 5 shares. Right. You go to the mutual fund and get a redemption for your 5 shares, and you get right. So you tell them, hey, I want to liquidate my 5 shares, which based upon the net asset value is $10 a share. And they're going to give you out $50. And then I'm going to go to the mutual fund company and say, I want 5 shares. And they're going to say our net asset value is $10. And so they're going to say, we want $50. And I pay $50, right? Now, you might have an intermediary like Schwab or Fidelity or Vanguard or whoever help facilitate that process. But at the end, it's not, your shares aren't going to me. Your shares are getting redeemed and I'm getting brand new shares.
Yeah.
And so it's not happening on an exchange. And that's why mutual funds only settle at end of day, right?
The trading,
So everyone gets that same strike price at the end of the day, which can become important on trading cost. But yeah, it's that end of day. But also what that does is like, you can't day trade mutual funds.
No, you can't.
You also can't call up and just say, man, I think the market's going up, but it's on a little bit of a dip midday here. I'd like to get my money working now. You can't. You can always say like, I think the market's going up. I'm going to put my order in and it gets executed at the end of the day.
Yeah.
Or I'm trying to get out and market's, up. I'm trying to get out while it's up. Nope. You just put the order in and you get out at the end of the day.
Which as an advisor, that's kind of nice because then it's just, you just wait. It's not like I'm trying to time something. It's just, it is what it is.
For most advisors, I think it'd be like, I think it's very nice. Sure. For me, not so much maybe. Anyways, but no, I think there's, some people say I like the value in the optionality, right? Like, cause you can still choose to say, I'm going to get out today, but I'll wait till the close to just see where the market goes and just treat it like a mutual fund.
Yeah.
And some people like knowing that if the theater's on fire, they don't have to wait till the end of the day to rush to the door.
Yeah.
Jack Bogle thought that was a bad feature for most, that's the guy that started Vanguard. He thought that was a bad idea for most investors. He thought a mutual fund was a better chassis because it would force them to wait till the end of the day.
Yeah.
And maybe like, cooler heads would prevail sort of deal.
Right.
So, I feature benefit. I don't, whatever, pick your poison. We're just talking about the differences here.
Yeah.
Liquidity and trading. The average daily volume of an ETF determines its liquidity.
Man, I don't even know that one. I want to say no.
Yeah, not true.
Okay.
And let me tell you why. The liquidity of an ETF is a function of what it holds, not of the ETF volume itself. So if you have an ETF, like let's talk about bonds, right? Bonds might be a really good example. If you have an ETF that under the hood, they own a bunch of bonds, like something like bullet shares, right? Like iShares bullet shares will hold high yield bonds in their fund, right? You can just go look it up. You can go on their website, pull it down, see all the holdings in the funds. ETFs are very transparent.
Yeah.
If your liquidity is based upon their ability to sell all of those bonds,
yeah,
and get you your money out of those bonds, right? So if those bonds are high yield bonds and the market's selling off and like they got to try to make market on all those bond positions, that's really what determines your liquidity because ETFs go through that create redemption process with a qualified participant. So when you're trying to get your money out of an ETF, like this happens so fast nowadays because of like computers.
Yeah.
But you're going to say, I'm trying to sell this fund. You put your order in at, like you just think like, oh, I'm just on charlesschwab.com and I just hit sell. And then, boom. Well, that kicks off like, thousands of algorithms running and all this stuff. It's like what it's kicking off is the ETF now is saying qualified participants got to come in and they are going to try to redeem basically your shares and then make market on all those. So they have to basically like sell it for parts, if you will, right? Like think about it like that. Okay. Like they got to take your shares and sell them for parts. And so if the underlying assets, like no one wants to buy your share, it's got to get sold for parts. If the parts aren't liquid, that's really what determines your liquidity versus if you own a bond fund that's actively managed and say it owns like shares of some really liquid bond ETFs under the hood, right? Like the most common stuff, like a TLT or an IEF or whatever, right? Like just really, or AGG, right? Like AG. It says like some of these really highly liquid ETFs. Well, like when it gets sold for parts, if the parts are liquid, right, that's your true liquidity. Yeah. Right. So the daily volume of an ETF doesn't determine its liquidity. However, an ETF can still be thinly traded and illiquid. So you got to understand what the liquidity of the underliers are, not of the actual ETF itself.
Right.
ETFs with higher trading volume are better investment options.
I mean, that's not true, but I mean, that means liquidity is going to be a little bit better potentially. You tell me.
What makes a better investment option? I don't like, I don't know that I know what that means. To me, if I thought better investment option, I'd think more return or less risk.
Yeah.
One of those two, right? Like those, if I'm going to define something as a better investment to an alternative, I'm either wanting less risk or I'm wanting more return. That's
right.
That's pretty much it. I don't know that an ETF with more volume offers either of those things inherently.
Yeah.
So
it just means it's more popular.
I would say if there's a correlation, it's not causation.
Right. Maybe it's known more. I mean, when you think of when you think of the S&P 500, what comes to mind? What ETF comes to mind? SPY. That's what comes to mind. Right. Yeah. Does that necessarily mean that because it probably trades, it has more, does it make it a better investment? No.
Not in and of itself, volume cannot make something a better investment.
Right. Okay. Yeah.
Okay. I don't think ETFs pose a liquidity risk to the market. However, I think what this myth talks about, have you heard of the theater on fire theory?
I swear maybe. You're going to have to remind me. I think I've heard this before.
So this is popularized by a little bit, there's some, I think Michael Berry, he is one of the guys from The Big Short.
Yeah.
I think he's talked about this. So if he hasn't, disregard. But the idea of the gist of it is if you're watching a movie, everything's fine when everyone's watching and enjoying the movie.
Yeah.
It's but if a theater catches on fire, it's everyone runs to the exit.
Yeah.
And only so many people can get out, and so now you are willing to pay any price to get out of the theater because you now realize it's on fire, right? It's so when everything's fine, you can get up and leave and go get popcorn. Somebody else come take your seat and whatever, right? It's you can come and go. But once it's on fire, everyone wants to get out. And so what they say is that ETFs right now, because of all the passive investment coming into the markets, it's creating a potential bubble effect. And everything's fine right now because people are enjoying the movie, right?
Yeah.
But when the fire starts, everyone's going to want out, and everyone's holding these same, passive ETFs. And so they will, run to the door, and there's not enough liquidity in them to, get out in time.
Now remind me though, isn't there certain triggers in effect that if the market were to drop certain levels, doesn't
a circuit breaker?
Yeah. But I can't remember what that is or what triggers that.
It's the last time we hit circuit breakers was during COVID, I think.
Okay.
Except in the futures market, I think circuit breakers are a bit more a bit more sensitive and a bit more common. But in the equities market, I don't think we really hit circuit breakers too often, especially in broad market conditions, maybe in certain stocks. But But that what's funny is all it does is breaks the algorithm. So the circuit breakers is not to stop an actual crash that's going on for a reason.
Yeah.
It's to stop algorithms from that automatic feedback loop potentially triggering. So it's designed to stop all the trading so that everyone can kind of reset their algorithms really quick so you don't get auto sold out.
Right.
Right. And anyways, the whole idea is that there's all these people going into passive funds and in ETFs in particular has been the hot thing to talk about. And so if everyone wants out at the same time, you're going to have a big loss because you want people to get out.
Yeah.
And what I can tell you is that's really not a liquidity function of the ETF itself. That's just the market. It really doesn't matter what you own when that happens. You're probably going to experience this, they say in bear markets, the only thing that goes up is correlations. So it really doesn't matter if you own the good stock or the bad stock. Chances are they're both just going down. And it doesn't matter if you own it doesn't matter if you own the value ETF or the growth ETF. They're probably just both going down.
Yeah.
And it doesn't matter if you own, this sector or that sector. It's just chances are they're probably both going down. It's when margin comes unwound, it kind of, it affects everything. Right. So, risk and volatility. ETFs are more volatile because they are traded throughout the day. True or false?
Man, I want to say maybe. No, I mean, not really, because you're still going to have to deal with it at the end of the day, whatever you end up getting. I mean, I don't know. What is it?
Dude, if your grandma's taking a shower, she's still naked.
Well, yeah.
You don't want to think about it, but it's still happening, man.
Yeah. I guess, you don't think about it as much with the mutual fund. You don't have a choice.
A mutual fund isn't repriced throughout the day, right? Now, if you have an advanced tool, like if you know where to go look, you can look at a mutual fund's NAV or its net asset values throughout the day. Okay?
Really?
It is reported. No one knows how to freaking go look unless you're like, you know what I mean?
Yeah.
See, like you've been in the industry for like 10 years, man. And
I don't.
And you're like, that's the first you've heard of it. It's like no one looks unless you have a Bloomberg terminal. It's like only the people that nerds point to and go, those guys are nerds.
Yeah.
Those are the guys that would kind of even care. And the reason why is they're you can arbitrage against a mutual fund potentially, right? And that's why it's still reported intraday. But the volatility is still happening. You just don't see it because it gets priced once a day at the end of the day.
Yeah.
But all else equal, if you have an S&P 500 index fund in an ETF and you have an S&P 500, mutual fund, the volatility risks of those are still happening.
Yeah. And it's not like they're, Okay.
Sorry about my grandma reference. Okay. Let's see. ETFs inherently riskier investments than mutual funds.
Inherently riskier. I think you just kind of answered that question.
I don't feel as if there is any difference.
No.
Passive ETFs are safer than active ETFs.
Man. No. Well, it depends. Right? There's so many factors to consider.
A passive or an active ETF in and of itself does not change the nature of it being active versus passive. Doesn't inherently change whether or not it is more or less risky or more or less volatile than the other. Right? You have to. So, quick example: if you have a passive ETF that's S&P 500 index fund. And then you have a active ETF that's a bond fund. It's just a completely different thing.
Yeah.
Right? It's like one's an index fund in equities and one's a actively managed bond fund. It's way different mandates, right? So you'd really have to compare apples to apples. So you'd really have to say, okay, S&P 500 index, fund versus a large cap, actively managed, ETF.
Money manager.
And what I'm going to say is, it could go either way, right? Like an active manager could outperform, they could underperform.
Right.
There's not going to be any shortage of people in the comments telling me that, active managers are statistically going to underperform. And all I'm going to say is, I didn't say they would. I said they could.
Yeah.
And they could be, their mandate could be not to outperform the benchmark on return. It could be to manage the risk at a lower level than what the benchmark is, right? Like, so it goes back to why do you own something, right?
Yeah. Yeah.
ETFs are only for day traders and short-term investors.
Yeah, it's a fault.
I would say the longer time frame you are, the more compelling it is to own an ETF versus a mutual fund.
Yeah. I would agree to that. Just thinking, especially if you have it, I don't know.
I would say generally speaking, ETFs are going to carry lower fees on a carry cost. So what I mean by that is they will cost less to own. So if you're intending on owning something for an extended period of time, I'd like to own the thing that costs less, right? Like, I mean, if every single other aspect about them are the same, give me the one that costs less, right?
Yeah.
So and what's funny is that day traders would have to use ETFs because you need that intraday sellability.
Yeah.
But swing traders, somebody that maybe your holding period is, anywhere from 1 day to a couple weeks, you might really consider mutual funds. And the answer is really dependent upon how often you trade.
Yeah.
And that is a function of payment for order flow. So when you trade an ETF, remember that you trade it like a stock. Well, stock, like we don't have brokers anymore that we call up and say, Aaron, get me out of Apple and buy me Microsoft, and you're like, sure thing. I charge you, 2% to make that trade, and whatever, right? Like,
yeah,
you don't do that anymore. And so everyone's like, oh, trading's free. Trading's not free. You don't see the fee because it's not a fee. It's a cost, right? It's like, which is a nuance difference. But when your share of Apple or whatever, I always use Apple as I don't know why I always use that as my, like,
it's a big one.
It's a big one.
Yeah.
Some might say it. Sometimes it could be the biggest. I'm going to intentionally use a price that's way off here because I know it trades more than this, but let's say you're looking on your screen. Apple's trading $100 today. Like, that's awesome. I'm going to go ahead and sell. Okay. Chances are you are not going to get $100 for that share. Okay. Now, fluctuation in the market might make it go a little higher by the time you hit sell and might make it go a little lower. Yeah. But in a perfect world in which the market doesn't change at all, chances are you are going to probably get something more like $99.98 for that. And that 2 cents is what's called the bid-ask spread.
Yeah.
So, that if in the buyer on the other end, it might go in the way that, you get the $100 and the guy pays $100, 2 cents.
Right.
It's like, there's a spread and, it's called level 2 data. You can look at it. You can look how wide a market is. They call it how wide. And it's just the difference between the bid-ask spread on something that's really liquid, super liquid, like these mega, tech companies and Apple and Google and Microsoft, like those are not thinly traded. They're very liquid. Yeah. And the bid-ask spread is very tight, very, very tight. On something that's like a penny stock, you might pay like 1% to 2% actually just in bid asks to like trade something like that. Yeah. ETFs that are thinly traded, if you don't know how to make market on that appropriately, right? Like you're just, you're on your retail account, you pick an ETF, it's thinly traded, and you just hit like, oh, a market order, send that through. And remember earlier I talked about, they go out and sell it for parts, or they go out and, gather the parts to make you a fresh share. If you don't know how to execute that correctly, then the market makers can absolutely just take advantage of you. Yeah. They have no obligation to you, and they'll take you for anything from like 1% to 5% on the cost of that. And that's pretty freaking brutal. So that's what you got to understand, how to run a limit order, so that you can kind of put some limits on them. Now, if you are trading something a lot, right? Like if you're going to trade, let's say more than once every other week or so, right? So you're pretty frequent, right? Like, and I'm not talking like buy or sell one share. I'm talking about like you are going to do like a sector rotation idea, or you are going to do a very tactical idea. Like I'm going to put all my money in the S&P 500. I'm going to pull it all out. It's like big chunks of money.
Okay.
Right. Not like, oh, I got paid again, I'm going to buy another share, right? I'm talking about the whole, a whole position coming in or going out of the market. We're going to do that 24 times in a year. You might actually pay less on a mutual fund, even though the expense ratio is higher. And the reason why is first off, even if the expense ratio is, let's just say 10 basis points on an index ETF, but it's 1% on a mutual fund. Mm-hmm. Well, right away, if by nature of it, your system has you out of the market half the year or something, right? Because you're only trading every other day or something. Long-term investors, disregard what I'm saying. You are only paying 50 basis points by nature of like, you're not always holding it, right? You only pay an expense ratio while you're holding the asset. Yeah. But more importantly, every time you go in and out, you would pay that bid-ask spread on an ETF. Mm-hmm. And so although it's only small,
I'm seeing what you're saying.
Because it's only small and you don't see it, you think, well, that doesn't really add up. But on a mutual fund, remember, you get that end of day NAV strike. Everyone pays the same price. There's no drag.
Yeah.
Okay. So theoretically, you can add anywhere between depending on the instruments you're trading. And I've got a white paper to justify this or support what I'm saying here. If anyone wants to reach out, I'm happy to share it with them. Anywhere from like 1 to 4% in fees on ETFs from trading ETFs versus mutual funds. because the bid ask spread kind of adding up as an annualized cost.
No, I never looked at it that way. Mathematically that makes sense. And what I would, of course, tell my clients is please stop trading so much.
I could see how that would be your thought track. But like we have some systems though, like at our firm that we do trade very actively, right? Yeah. Now we don't trade these as a way to like beat the market. You know what I mean? Like we're not trying to just beat the market on like, oh, we think we can time the market to increase our return. Mm-hmm. But we are very unique in that we do have some strategies that we will that we do implement some market timing stuff, and we do go to cash, and we do trade short on some systems. And because of the time we spend out of the market, when you're in the market, sometimes you want to use leverage so that you can make, right? If you have something
take advantage of a situation.
Yeah. The idea is saying like, hey, if the indicators say it's a good time to be in the market, let's be extra in the market because we got to try to make up for the time that the indicator said it's a bad time to be in the market. So we're going to be out of the market, knowing that some of the times when you're out of the market, you're going to be missing out on the good times. Yeah. Right. Yeah. Now, if the idea is to limit your exposure, which is what we do, we try to limit our exposure to, tail end events in the market and huge major, losses with those types of strategies. Then they trade a lot, and we trade typically leverage mutual funds. And I learned all this because I asked a question like a couple of years back. I was like, why do we trade leverage mutual funds instead of ETFs? Because the ETFs, leverage ETFs even have a lower expense ratio. It's like, it just seems like we should be trading the ETFs. Well, upon some further research on a very deep level of how all this stuff works, it's like, we're actually like, it would be way more expensive to trade the ETFs, even though on initial analysis, it would look like it's more expensive. Right. So there's that. ETFs aren't suitable for income investors since they don't pay dividends.
ETFs do pay dividends.
The worst ones pay dividends, Aaron. Okay.
No.
ETFs can pay dividends. Here's the crazy part is, ETFs aren't required to pay the dividends. But
is that just in their mandates or whatever?
They do it because ironically, they do it because advisors wouldn't otherwise understand basically how to use the ETF in the portfolio or position it with clients. So I actually talked to a fund family or fund company, and I work with them. I use their fund, and they pay out 50 basis points a month. Not required, but that's typically about what they pay out. Huh. And so I go, dude, I love your guys' fund so much. I think it's such a great idea. It's a brilliant idea. Everything about it is awesome. You guys do so much focus on tax strategy under the hood of the ETF. Why are you doing this distribution? You could just have the share price go up and just let people, when they want their money, just sell it and get capital gains. And they finally just said, Brandon, if we didn't do that, people wouldn't understand that like the idea of our fund is to generate income. Mm-hmm. And so we provide the income as a way for investors to understand that like they're going to get, the idea is to get income by owning the fund. Yeah. And I went, it's just bad tax planning. And it's like, yeah, that's not, most people aren't, nutty like you, Brandon, yeah, but they don't have to, right? And so most ETFs will pay dividends. They'll pass dividends through, they'll pass interest income through.
Right.
But ETFs are very actually tax efficient in that they don't have to go through, because of that create redemption process. Mm-hmm. They don't have to actually send the dividends out. So I almost think about ETFs when it comes to the tax efficiency piece like this, like its own little tax shelter. Okay. Yeah. Like if you buy a fund that doesn't do dividend distributions at all or capital gain distributions, like you can buy a share and whatever the manager does under the hood of the fund, like it just increases the value, hopefully increases the value of the fund. You get to choose when you want to sell it, just like you get to choose when you kind of take money out of your IRA. And as long as you don't touch it in the meantime, like you just keep getting this sweet tax deferral.
Yeah.
mutual funds are not like that. Mutual funds are quite the opposite. And by that, I mean, like I could go in at the beginning of the year, or go in halfway through the year and buy a mutual fund that earlier in the year got absolutely smoked. And it's down like 20, 25%. And so you thought, well, I'm going to get the heck out of this fund. So you sell and I go buy, 6 months later, and at the end of the year, I get a tax bill and I'm like, what the heck is this? I didn't sell. And this fund hasn't even made any money.
Yeah.
And they go, well, but Aaron sold his shares earlier in the year. So we had to sell some of the assets of the fund that did have a gain built into them from something we bought the year prior. Yeah. And so as a fund, we had to realize that income, and thus we have to do a capital gains distribution, and we're giving you a tax bill here.
Yeah.
Congratulations. What the frick? That sucks.
I've had too many, in my short little experience being a financial advisor, I've had I have not had good experiences with having mutual funds in a taxable brokerage account. I've had these capital gain distributions that have happened where you have no control over it. It's going to happen to you, and you're going to have to pick up that tax. I've also, when it comes to, I do a lot of tax planning for clients, or just kind of helping them with their investment accounts, where if I'm trying to take advantage of some tax gain or tax loss harvesting in a taxable account, mutual funds they're not as easy to do something like that compared to an ETF. And so I don't know if I've been jaded, and I don't know if you have a different opinion, but when it comes to like a tax brokerage account, to me, I like ETFs. The problem is there's, again, the no free lunch thing. There's pros and cons with having anything. I just steer in my own practice. I like having ETFs or even stocks in a taxable account compared to mutual funds in that taxable account, just from almost just a tax perspective.
Well, I think mutual funds are still being used by big shops or shops that are on platforms that automate stuff for firms a lot of times.
Automation, yeah. Mutual funds are really good for automation.
There's a certain custodian out there that I would say is really kind of guilty of this. You wouldn't be surprised if
Oh yeah,
it's got 3 letters. It's commonly known for. And so the advisors kind of use whatever, what their models are, which is oftentimes then their mutual funds.
Yeah.
And so it's kind of free to the advisor. It's positioned as maybe like sort of free to the client, but again, no free lunches because this company is now making fees on the mutual funds you own. Yeah. And if it's in a brokerage account or a taxable situation, that's potentially unfavorable to you. If you're in a qualified account, I mean, you can have a conversation here or there about, where you're paying a fee and how much and what do you get in return. But from a tax perspective, right, it just doesn't make a lot of sense. But sometimes advisors don't have the capacity to pick a better alternative, right?
No, exactly. I mean, one of the cons with something like that is, well, if you're buying an ETF that acts like a stock, and let's say you wanted to automate an automatic investment where you put in $100 every couple months. Well, you can't do that with an ETF. Not that I'm aware of. With an ETF, you have to have a certain, that's a certain share price. And if you don't have enough cash for it, that cash is just going to sit there. Compared to a mutual fund, you can automatically invest it at the end of the day, right? Because it just is
a fractional share. Yeah, like mutual funds are still set up more for fractional shares, but I would say that's largely that's a moot point. I think if you're like if your account size is like $100 and your contribution is $5, sure, but
right,
a lot of share prices now are like $30, so you're talking about like a very minimal. You know what I mean?
Well,
like a very minimal drag.
Depending on how I invest for a client, I mean, I need to have some type of minimum in order to get to kind of utilize ETFs, I guess you could say.
Sure. Yeah, there's nuance. I guess here's what I'm going to wrap up the episode on, is that mutual funds are both incredibly value and are incredibly archaic.
Yeah.
Right. There is some times which I laid out today, which like they would make a lot of sense. They do make more sense in certain very specific situations. Some things you just can't get in an ETF wrapper because of the nature of how they are constructed, right? Particularly like oftentimes when you start looking at stuff that is uses a high degree of leverage or goes long and short, that is less common to find in an ETF wrapper because an ETF provider doesn't typically want to take on the risk of making market on that. And so a 40 Act fund like a mutual fund is typically still going to be your primary wrapper to find exposure to that type of investment. However, like if you're the vanilla guy, you're like hey, I like buy and hold. I'm just happy to ride out the vanilla stuff in the market and be happy with market returns. And that's all like great. And I keep it simple and that's cool with me. Like if your advisor has you in mutual funds still, or you have your own portfolio of mutual funds, you really should be taking a second to stop, review that, and maybe be getting a second opinion even.
Yeah.
So, that being said, I'm happy to sort of like wrap on that.
Yeah.
Unless there's anything else you want to add.
No, I just like everyone's situation, it just depends.
Yeah.
Right? It depends on so many factors, and I would agree. Always, I think it's always good to get a second opinion as well.
Yeah. Okay. Well, everyone knows where to find me. If you want an opinion from Aaron, because you like him, you think he's much cuter than I don't blame you.
It's the beard.
What's wrong with my beard, man?
It's not as burly as mine.
Anyways, Aaron does a nice job as well, guys. He's a good friend of mine. Find him at bestwealthadvisory.com.
Bestwealthadvisory.com.
Yeah. So, second opinion from me, second opinion from Aaron, if he's willing to find time for you. And we wish everyone success in their endeavors and glad to do what we can to try to support people along that mission.
Yeah.
So reach out if you need something. You know where to find us. Until next time, everyone. Bye.
See you later.